And just when you thought things are about as crazy as they can get, even crazier happens. Yesterday, we had the largest drop in mortgage interest rates since the global recession of 2009. Unbelievable. After months and months of increases, rates dropped tremendously. What does it mean to us? Well, let's take a look at the data first, and then we'll look at that. What happened? Well, basically, the consumer price index gets announced every month. And it was forecasted to come in about 0.5% month over month, which times 12 is about a 6% annual rate. And instead, it came in at 0.3, which is 3.6% interest rates, inflation over a yearly period if that rate held. And so basically, the market realized that they were assuming a 6% inflation rate when it's dropped to 3.6%. And it's not that necessarily just inflation going down is good. There's also the effect that the reason behind it might be signs of a more imminent global recession or U.S. recession. If that's the case, in a recession, people can't afford to buy goods. Naturally, there'll be less demand and rates go down. So when the market's off that much, see, when they expect a 6% rate of inflation, then bond rates at 7% makes sense. But if the inflation rate drops down to 3.6%, then mortgage rates below that make more sense. And that's what's really happened here if you take a look at the data. One thing to notice is the difference between what they call the headline number and the core inflation rate. What happens is there's certain numbers that get the attention, but then there's other numbers behind that are the actual numbers. And what we can see is that for the last few months, the headline numbers have been much lower, but the real core inflation has been higher. And people knew this. People knew statistics were being manipulated. Maybe it's because of the upcoming election or for whatever reason. But the fact is, for the last 3, 4, 5, 6 months, we know that inflation was higher than we're being told by the Economic Bureau. But what happened different this week was the headline number came in about 0.4 and the actual number came in at 0.3. And as a result of that, it caught all the economists by surprise. You can take a look at the drop in the CPI data of expectations going forward on this chart here. And then you can see the S&P stock futures, which is where they expect the stock market to go, and the 10-year drop in bonds. And those two things go opposite. People either put money in stocks or bonds. When stocks are good, they sell bonds. When stocks are bad, people sell stocks, put the money in bonds. And so you can see the bond rates dropped along with the stock market, which got a lot of news yesterday for the largest increase also since 2009. You can see the day-over-day yields, and this is over time, and you can see the last time the numbers were this dramatic in one day was 2009, the global recession. And then prior to that, the most recent was the pandemic, when the pandemic first started. The volatility changed day over day. And so what happened to interest rates? Well, we've been marching up steadily. I've been reporting for months. The mortgage rates have been going up over 7%. In fact, we're at 7.26 yesterday, and boom, down to today 6.75 or so. So you can see about a 0.5% drop in rates from a week ago. And you'll see the Freddie Mac survey average will still report probably over 7 because that data that's in the news is always fake. It's always late by a week or two. But the actual mortgage rates you can get today are below 7 at about 6.75%. So what's all that mean? Well, first off, if you're a buyer right now and you have a loan, if you're not locked in, you should get a lower rate. If you are locked in, talk to your lender about getting an adjustment. If you're a seller, your buyer may need to redo the paperwork, redo the loan to get a better rate, and you may or may not want to cooperate with that, but just know that's the factor. Also know that for all the doom and gloom, it wasn't just that rates had gone up to 7. It was maybe the belief they'd go to 8, 9, or 10 that caused people not to move. If, in fact, this is a change in direction of expectations, then all of a sudden there are buyers who will pop back in the market and sellers will be able to move out of their house into new properties. So not sure what it means overall in terms of sales activity. The sales market has been overall nationally still pretty solid for November, which is always seasonally a little slower anyhow. And so as always, we'll look at the data a little more in detail with my Monday morning report. But I wanted to report to you right now because if you're buying a house or selling a house over this weekend, get your rate locked in. Take advantage of this opportunity. Tremendous savings. 0.5% on an $800,000 loan could be $4,000 a year. It could be a car payment. So take advantage of those opportunities. If I can help connect you with a great lender, call me, text me, email me. Bill Gross is always the LA Probate expert. Make today your best day ever. Thanks.